Alright, so recording is started from my end, Jay. Just make sure yours is on as well.
Yeah,
Alright, perfect.
and my end is recording right now,
Alright.
so we're good to go.
Jay, just confirm that if the screen is appearing or not.
Yeah,
If
screen is perfect.
alright, so hello everybody. This is Blaine here, and I welcome you all to this webinar session. So this being the first session, and I will be managing this one. And these are some of the. Sorry, who is it? Uh, um, Jay, just mute this.
Having troubles hearing you. I don't know if it's my network, but currently I'm having troubles hearing you.
All right, so in this session, I would be covering this eight topics specifically, and probably many of you are smart money traders. They have learned the smart money concept, and they will be wondering like these are basic stuff: market structure, liquidity, liquidity grabbers, and market structure, momentum. Like some of the stuff is very commonly in all of in the courses you will find on Telegram. Like there are many mentors out there who are teaching this stuff. So you may be wondering like how is it different from the ones which are in the courses present. So if you observe my 7th point, which is the setup, all right. So I'll be explaining a proper setup, all right.
Hello, Wena,
Yes, yes, bro.
was hearing you. So everyone out there who is having challenges hearing Wena, please you could activate your um what is it? Give me a minute. Let me check that. Okay, turn on your caption and it will help you interpret. Okay, I wish my time.
Um,
Please mute your microphone.
the way they say balance as well. Yeah. You know, say, but wait, how they the balance like that? How you want to make it? Like,
Sorry, please mute your microphone as you come in. If you have any question, please use the chat option. Make sure your microphone is mute, not to cause any confusion.
all right. So continuing with it. So these are some of the these five things are the main things which you need to understand this setup properly. Like I don't know like if there is anybody who has studied smart money concept or not, but I'll explain these five things properly that you would be in the end able to understand the setup properly, and I'll explain the setup and I will tell you where to enter, where to put your stop loss, and where to target, and there are some spaces where we have to take partial. So I will talk about the partial stuff as well. Like in a nutshell, it's a mechanical type of trading, like fixed confluences, fixed rules, and everything. I'll explain that. So number one is the market structure. Definitely market structure is the foundation. If you plot the market structures wrong, you definitely are building your foundation wrong. So, building a market structure first is an essential part in trading. And, I'll just go with with the theory first, and afterwards I'll explain that in the chart as well. So, basically, you probably know that if price is breaking structures to the downside, all right. Let me just all right. So if price is breaking structure to the downside, it's probably downtrend market, and similarly, if price is breaking structures to the upside, it's probably uptrend. All right. So breaking structures to the upside. Now, just hold on a second. Now, and a confusion here arises, like it's not as simple as this, like price is not usually doing this stuff. Rather, you'll see the price doing stuff like this, you know uh, something like that. Another impulsive wave, a correction, and an impulsive wave. Like, in the correction, it's not almost a similar, it's not a recent correction like what is taught in theory. Rather, it's some sort of structure breaking in the correction phase as well. Like it's impulsive correction, and impulsive. So in impulsive, on a shorter time frame, you will see this same thing as well, and when it comes to the correction phase, you will see this type of thing as well. So identifying that where the macrostructure first is, it will be something which will increase the probability. So first thing first, you need to understand where the market structure on a higher time frame is. The macrostructure, is it coming down? Is it going upside, or is it doing something like this? Is it changing character? Like, is it reversing? So here comes the part of the Wyckoff accumulation, and similarly vice versa. If price is reversing from going upside to downside, we have a distribution. So in the second session, or maybe the third one, Jay will explain the Wyckoff accumulations and distribution and different types of schematics, a simplified manner. So I'll leave that part to the Jay, and I'll just continue with the other things. Like, we have just four different phases. Is it market breaking down? Is the market going upside? Is the market reversing from upside to downside to the upside, or is the market going from upside to the downside? All right. So going a bit deeper into that as well, like you know we have this macro impulsive wave. All right. So I will just keep that here, and we have another macro. So we have a correction here. All right. So if you uh, where is it? So if you look that in a smaller time frame, you will see something like that. Where's that? Let me just make it favorite. So you will see something like that, like the micro break of structures. All right. So, and as soon as this phase comes, you will see another break like this to the upside, and as it comes to the premium range, we will be looking to shorts again, like this, a change of character, break of structures, so like that. So this is something in the market structure. Like I'll be keeping things extremely simple as possible, because the simple we have, like there is no reason to make things complicated for yourself. Like if you keep things simple, you will have losses. If you keep things complicated, you'll have losses. So yeah, like losses are inevitable. Like you can't avoid losses. So why should we stick with the complicated stuff when we can stick with the simplified stuff as well? So this was a bit of the market structure. Like if it's breaking structure downside, we have a downtrend. If it's breaking structure upside, we have uptrend. If it's coming down and we have a structure shift, like this is the last high, last low, price goes up and breaks structure. So this is the last lower high, this is the last lower low. Price goes up and breaks to downside. So we have this last lower high and lower low. So price to change the corrector, we have to see a break above the last lower high. All right. If price doesn't breaks that up, if it just wicks it, then it's not a validate change of character. So price really needs to break the structure and close above side. So that would be a decent break of structure, or the change of character, you can say in your terms. All right. So yeah. Uh, let's just go to the chart and we'll mark some structures. uh, Let me just go to a macro time frame. Let me just, all right, so we have this high right here. So price breaks this low right here. So we have this high, this low. All right. So you know uh, the recent high we have is this, and the recent low we have is this. So if price goes up and breaks the structure, we would have another break of structure. So the last high is this, and where the price pulls back, it's this. So the last low is this. All right. So next, uh, is this a change of is this a change of character? Like look at it, the price breaks this. All right, is this a change of character? No, it isn't, because look at the previous market structure. This was the last high and this was the last low. Like price was not able to close below this low, so we cannot say this as a high. All right, so if price goes up and break this high, then we couldn't say that as a change of character. Rather, what price did was, it just faked it out and break this structure. So we have this low and we have this high. So what happens now is price breaks to the upside. So we have this high low, we have this higher high. So we are now, we have now shifted our trend to the upside. Like we were pushing down previously. All right. So that is an example of a bearish trend. So right here we have a change of character. We have example of price reversing from bearish to bullish trend, and we are now let's just mark next thing. So this was the last high, this was the last low. Price broke structure to the upside. So this is the last low, and this is the last high. So we have a trading range right now. All right, we have a trading range. So recently the price has shifted structure to the upside. So the next thing we anticipate is that the price would be making another high. Like the price may be going to the upside. Like structure wise, we are bullish at the moment. All right. So let's just move down to maybe 15 minutes. Let's see. All right. So where exactly is that thing? Let me just have a look at it. All right. So see right here. So this was the area where the first market structure to downside occur. All right. This was the first, the price broke this one. So what do we have right here in this trading range? Like the market structure on 2 hour time frame was pushing to the downside. So let us see that what the price on lower time frame is actually doing. So this was the last high. The price very momentously broke structure to downside. So this was just more like a redistribution phase, and nothing much to mention, but we'll mark that. So we have a micro break of structure. This gives us this high. This gives us this low. All right. So price came and make this low. So this was the high and price broke structure. So next thing which price does is break structure to the downside. So this is our high and this is our low. So we had this trading range. All right. So trading range to look out for short positions. So we had this order block and price definitely broken another structure. So let's just keep marking. So the price broke structure with this move right here. So the origin of this move was this high, or this low. Sorry, this low. Gosh. All right. So this low and this high. The next thing what price did was it it did a simple pullback and broke structure again to downside. So right here, if you guys observe, like there are two candles, all right? So you may be wondering, like, can we look at this as a market structure, a breakup structure? Well, honestly, I would not consider this as a breakup structure. All right, like the breakup structure is gives us two things. Like, it gives us a trading range, and the next thing we get is like if the price broke structure to the upside, like the change of factor, that is important right here. So if price breaks above this high right here, like does that give us anything? Like according to the market structure, it actually doesn't give me anything, but according to supply and demand concept, like this was the last supply. So if price breaks above this high right here, that is actually a supply and demand flip. So this was the last supply in control. The price broke the supply, so that gives us the demand is in control. But according to market structure, that is not really an important thing for me. So this was the last low the price broke, and this gives us this high right here and this low right here. All right, but price goes up, comes down. This was the last high, this was the last low. But price broke structure to downside, so this was the last high. And where do we have, and this was the last low. All right, and the next breakout structure we have the high being here. All right, so it's keep breaking structure to downside. So let me just check it out on like the price, where the price actually reversed. Let me see if I have anything decent there. All right, so that was actually thing. All right, so that was a structure shift right here. All right, so let's just go to 15 minutes right here. So let's see, like if we could have refined our microstructures in order to get in that macro structure change of structure. All right, so like here was the last break of structure. This was the last high. Price broke structure to the downside. So this was the the last low. This was the last high, and this was the break of structure. All right. So you may see right here as a body break below this candle. So we would consider this as the last low, and we consider that as the last high. Sorry, the break of structure. So and price goes up and pulls back here. Yeah, this was the point. So this was the last high. So right now we have this trading range. All right. So this was the last high and this was the last low. So we had this trading range, and we have a change of character right here. And if you notice, we on a bigger time frame as well had a change of character. Not yet, but we have a change of character on lower time frame. So that means that the price has essentially made a new low on a higher time frame, and we can look for a new higher low higher to be formed. But what price did was, instead of forming a new higher low, it performed to make a new higher high. All right. Sorry, what I meant, what I used, just a second. Yeah, what I wanted to mention is that instead of price to make another lower high, it price made a new high. So uh, on lower time frame, we had already got a confirmation below right here, change of structure right here. All right, so we had this break of structure, so we have this range. So price comes back in this discount range and tapping this auto block, and we have a nice push up. So from there the price has been pushing upside, and we have able to get in with the macro change of structure. Like we would have inch around here, and we would have capitalized in this region right here, in this move right here. So this is just a basic interpretation of market structure, but uh, I will not try to make it complicated, but you rather try to keep it simple. You just explain that on theoretical wise and practically as well. So that's really enough for you to know, because as I mentioned, I'll try to keep things simple. Now I do have an excellent example, but let me just go back to the chart. Right, so alright, so liquidity, we have went over the market structure, and we know like when the price is moving upside, when the price is moving downside, like combining the 2 hour and 15-minute time frame, like the higher time frame and lower time frame. So we have pretty well went over the market structure, so there was no reason to talk about that anymore. So the next thing is about liquidity. All right. So what basically liquidity is like, it's an area where orders are lying. So we smart money traders have been taught like anything which is being taught on YouTube is pretty much liquidity. Like when a beginner jumps to forex industry, what he does is he goes to the YouTube and search for forex trading and stuff like that. So the things which usually shows up in his search bar is support and resistances, famous patterns, aka head and shoulders, double top, double bottom, and bunch of indicators like. So obviously that has been that has a confluence of the majority of traders, like they would be looking to short from resistance, and they would be looking to short from support area. So what does this actually shows, like we have this resistance. All right. So if price goes here and comes back, so what do you think, like if we didn't knew the small penny concept and stuff like that, what would we have done is we would have thought that this is a strong resistance. So managers will jump in thinking that this is a strong resistance, and price will try to bounce again from this level. But when we move to the LSMC concept, we have been taught that if the majority is selling from that level, like we know that the majority is selling, so definitely the institutions know as well. All right, it's not a big deal right here. All right, so if we know that the majority is selling, then obviously the institutions know as well. So we have been taught that such the famous patterns and stuff as support resistance have liquidity above side. Like if a major community is placing a short position, so they will be placing stop loss above this resistance line. All right. So we've been taught that the stop loss, which the majority places in any stuff like above this resistance or below the support, is actually liquidity, and price moves from grabbing one liquidity to the another. So we have been taught that price would do a fake out of this and grab the stop losses and then move to the desired direction. All right. So you might just understand. You might have known that. Sorry, uh, you might just understand that this is just liquidity in a simple way. So where liquidity is present more, uh, it's this resistance. All right, same thing with support. Uh, Sorry, that's messed up. So support right here, the liquidity is present below this support right here. Where else liquidity is present? It's present in the trend line. All right. So it's present in trend line. Similarly, if we draw this vice versa, we yes. So liquidity present below that, liquidity present above. Why? Because the price is tapping in a trend line, and third app, the price would the people would think that there is a trend line form. So the price again when touched it, this trend line would try to bounce to downside. But what usually happens is it fakes out, alright, and it fakes out like that. And similarly, like here, it fakes out the support as well. So It's not usually a case of three taps. It can be more than that. Like the stronger, the more the pushes, the more liquidity it's actually engineering in that specific trend line or support resistance or stuff like that. So talking a bit about more where liquidity is present, it's present at famous patterns head and shoulder. So as soon as this neckline broke, people would wait for a retest and go short. But what actually happens, according to us, is that this actually being served as inducement, and there might be a auto block right here. It's a bit vertical, but it works. I'll just try to make it, yeah, like that. So there might be auto block present, and the price might do is that a push upside and grab this high, this weak high right here. All right, so moving down, where else is this is a head and shoulder pattern, and if we just reverse it to this area, to this you know image, we can see that liquidity is present here as well. Or so we have liquidity present above equal highs. All right. So if there are some equal highs, the people will consider that as a double top, and they will try to short the market as soon as this neckline gets broken, and they will try to get in shorts. But what usually happens is that we as SMC traders consider this as a weak low, as an inducement. So there might be a odd block present here, or maybe an a breaker block of some sort of zone. So it can go upside to taking out this equal highs. So same thing with the uh, you know uh, equal lows, double bottom. So if majority would be looking to long setup as soon as this neckline gets broken. So there are a few things, a few more examples to this liquidity. That is, the specific one which we would be using is the Asian range. All right. So you may be, you probably know that if any sort of consolidation occurs, then it actually generates automatically support and resistance. Like if there's such sort of consolidation, then we have a resistance here, a support here. So price can fake out below that, or it can just fake out upside. So that is an essential part in understanding the setup. Like this specific part of liquidity, like this consolidation mean as the Asian range. So you have to keep this one in mind. And another thing we have to keep in mind is the weak low. So like if price is coming to downside, and so this one being the weak low, like if price grabs the liquidity from the previous lows, then that would be considered as a liquidity grab as well. So let me just go to the third point, and you'll understand that how this was not a break of structure, while this was a liquidity grab. Like you would be considering this as a low, as the higher break of structure, but for me this is more like a liquidity grab. So the third point being that as the liquidity grab versus the market structure. Let me just clear that mess up. All right. All right. So the third part is the liquidity grab versus the market structure. Like obviously sometimes a low or high gets broken, and people consider that as a break of structure, but in reality that is not actually a break of structure, rather that is a liquidity grab. So I just saw a pretty good examples on your USD when I was marking the structure, so I would why not explain there. Was this it? Perfect. So before I jump in there, you know uh, I have to elaborate something like what reality is liquidity. All right. So price actually needs fuel to move in any direction. All right. Price actually needs fuels to move in any direction. Like if it doesn't get the fuel, then it won't, it won't get the momentum or the volume in it. So and what is the fuel for the price? And that is liquidity. Like liquidity is the fuel for price, and once the price grabs the fuel, grabs the liquidity, it will probably have a good amount of momentum in it, all right, a good amount of volume in it. So uh, let me just give you a bit of theoretical right here. So we have this maybe not, maybe it's actually complicated like that in the reality, isn't it? So see that this was an impulsive move to the downside, all right. So what price did was, it was coming down, it was creating structures on a lower time frame, and once price broke structure to the upside, it again did a change of corrector right here and moved down. So if you observe, I've highlighted few things right here. Like, see, just observe the macro structure at the moment. So as soon as price broke this structure right here, the price continued to sustain below that. It just didn't went up again immediately in the range. But what price did was, it sustained below this low. So this actually shows that the price has intentions, it has still intentions to go downside. Like if this was a liquidity grab, alright, so if the price has, if this low was a weak low and this was a liquidity grab, this move right here was a liquidity grab, we would have seen a momentum to the upside. But what price it was, it didn't show any momentum. Rather, we are seeing the price sustaining, below this low right here. All right. So I, I don't think I'm able to explain that, but let me try to you know uh, tell that on screen. So see right here, this I said that this was the breakout structure. What price it was? It didn't immediately came back in the range. All right, the price sustained below there. All right, it sustained. The next breakout structure, the price sustained below there. All right, so we had after this you know uh, impulsive move. This was the last low. All right, and this was the last high. All right, so we had this little high right here, and if you observe, what is that? What did price did? It came upside, all right, and it immediately came back in the range. So what was that? This was a liquidity grab. This was not a break of structure. Like if I was on a 15 minute, we definitely would mark this as the break of structure, all right. This being the low, this being the high, and this being change of corrector, another break of structure. But in reality, don't forget the higher time frame, all right. Don't forget the higher time frame. What price did was, it just didn't break the structure. If this was a break of structure, then we would have seen, a sustain above this high. Like it shouldn't be, coming below this high right here immediately. It should sustain above that and continue to push up, then maybe come back in the range. But price didn't actually do that. So we have a clear example of liquidity grab right here. That is not a break of structure. That is not a market structure shift. That is a liquidity grab. Price comes back. This was a bullish momentum. Bullish momentum got stopped out like it was nothing, and bearish momentum appeared. All right. So that shows that the price has got the fuel which it needed to push in any direction, and that direction was to the downside. Now again, what do we have? We have this low. We have this high. What did price did right here? Was this was a liquidity grab or a market structure? A price came down, immediately went upside, and we have the liquidity grab on a macro time frame. So what did we have? A tap in and push to the upside. Now next thing I want to explain is that you know uh, I have considered, when I was marking structure, I had considered that as a low and that as a high. So there's there are no fixed rules in trading. Like trading is an art, and you have to be flexible with everything you are doing. All right. So they are not fixed rules. So, but I've tried to compile things in a rule-based thing. So I'll explain that why I've considered this high and this low when in reality that was a liquidity graph. So see right here, let me just explain that. So if that was if we have a body break below, body close below that, all right. So if in such cases, if we have a liquidity grab right here, and if in the liquidity grab process we see some body candle close below this low right here as well, then we can mark this high as well. But in case if there was not a body close right here, but in reality that there was only a wick right here, then we would not be considered as the market structure high. So let me just explain that again. Uh, when we have a liquidity grab such as this, like we have candle close below such lows and immediate tap to the upside, immediate move to the upside, we would consider this as a high, market structure high, market structure low. But if there were no candle close below, rather just a wick and body close above side, then we would not be considering this as a high, rather this as a high. All right. So that is a bit of more like rule-based stuff. Uh, where in reality, I'm not trying to. I'm just trying to make it rule-based. Let me just see if I have it. So we have an example right here. So this was a low. What price did was, it went up, and it just started to go downside, with huge momentum. So that was more like a liquidity grab right here. So can I mark this as the low on a macro time frame? No, we cannot. We cannot, because this was the microstructure break. This was the last high, the last low. This was the last high. So we are still within the range. So I'm not making this as the the macro structure low. So if price definitely it broke above, but it broke above, but it was a liquidity grab. So I'm not making it as the labeling as the new high and this as the low. So yeah. So I hope you understand like what is the difference between market structure shift and a liquidity grab. So you always should, to avoid such circumstances, you should be looking for a double break of structure. All right. So sometimes it's not really easy to spot the liquidity grab, but if you do, just try to look out for one break of structure, two break of structure, and on the retest, you can look for short positions right here, and you can maybe look at here. This means there's the weak high right here and inducement right. What you can say. So that was a bit of a difference between um, inducement and uh, market structure. So you probably know, probably by now, that what is actually momentum. I've explained that, but let me do that. So momentum is actually consecutive and highly bullish candles or highly bearish candles, like consecutive. All right. So I'll just go right here and I'll try to spot all the high momentum waves which we are seeing. All right. The first thing we have this momentum. We had this. Right. Just look at how many pips it covers. So we had this momentum. All right. We had this momentum right here. All right. Let me see if I can find any more. You can say that as momentum, but for me it is not, because the next candle we are seeing is a a bullish candle. So that is just a gap in momentum, and we can see possible buyers in the future, which we actually did right here. So we have this momentum right here. We have this momentum right here. All right. We have this momentum right here. Yeah, we can consider that because the consecutive bearish candles. Just look at the number of them. So we can consider this as a momentum. This as a momentum. So momentum is basically like the consecutive bearish or bullish candles moving to any direction, and we are seeing a huge volume in these candles, like such as this right here. So it's basically nothing more than that, but it's just this. So few things which I want to cover about momentum is that there are few scenarios which can occur and which can give you a direction bias for your setups. So, so we had a momentum like this, alright? We had a momentum like this, and what price does afterwards is something like this. Like it's not, it's more like a consolidation, alright? It's not pushing downside. So in such cases, what we usually see is that you know uh, seeing the history, like before this consolidation, what do we have? We have a lot of buyers pressure, and in this consolidation, what do we have is that the buyers are not being able to get stopped. Like the sellers are trying to stop the buyers, but they are not able to push the buyers to the downside. All right, so the sellers are it seems that sellers are weak. So what usually happens is that the price tries to goes up. All right, so that's more like a port flag pattern. So that usually happens. But there's another scenario. If in case if you are seeing something like that, if you're seeing a sudden retracement of this bullish momentum, this shows that the bullish momentum was just more like a shakeout. All right, so it was not really something that has a strong potential. Rather, that was just an exhaustion of the buyers. All right, so there's a difference between buyers having potential and buyers having exhaustion. So when we have a consolidation, that shows the buyers have really have more like a potential to the upside, and in such cases we observe and we consider this as the buyers being exhausted. So in such cases you can definitely look out for short positions, and if such consolidation stuff like happens, you can look out for long opportunities. And talking about consolidation, in consolidation we usually have either accumulation, sorry, redistribution or reaccumulation. So Jay will explain that thing as well in his session number 2. So I'll leave that thing to him. Like there is a chance the price might consolidate and goes up in downside, but the usual thing I have observed in my personal experience is that in such cases, if the bullish momentum is strong, it usually goes up. All right, and if the momentum is pretty much stopped up by sellers, a good amount of sellers, then we will be seeing sellers more like to the downside. All right, so let's let me explain that on the chart. All right, so let's see here. So we had a bearish momentum. The price consolidated. It was definitely a redistribution phase within this region, within this consolidation. So we had a push to the downside. All right. The next thing we observe where I marked momentum, yeah, here. So here was the bearish momentum, and what price it was, price this candle engulfed this candle right here. Like it didn't try to consolidate. Rather, we saw good amounts of buyer's entry, and what price it was, it just went upside. All right, so we had this bullish momentum again. So price did price try to consolidate? No, it didn't. Price at this point was literally coming downside, so we can look for short opportunities from here. And we had this bullish momentum, we had this consolidation, but we had again a push to the downside, so that was definitely a redistribution distribution phase. So yeah, Jay will explain that thing. But normally what happens is that if the bullish momentum is stopped by the bears, then the bears are really in control. And if the bearish momentum is stopped by the bulls, then the bulls are strong in that scenario. All right. So that's pretty much it for the momentum. Yeah, I'll just cover that. So moving down to the next thing is um, Fibonacci golden ratio and premium discount areas. All right. So let me explain that from theoretical perspective first, and real market. So see that if price was breaking structures to the top side, or it broke structure right here, then we definitely would be expecting a pullback, and from that pullback we would consider that as a higher low, and we would see like it should be heading upside. All right. So the question is like where the bullish this retracement would last. All right. So from elite with perspective, there are different types of Fibonacci levels, and different types of wave and Fibonacci levels according to them. But the one I will be teaching you is the golden ratio, and that is the only one we would be implementing in the setup, which I would be telling you in a while. All right. So just a basic example, like how should we even draw the Fibonacci. So we had this impulsive move, a correction, and again an impulsive move to the upside. So we had this break, all right, break above this. So this was the last swing low, and this was the last swing high. So if the price is really like, we would be looking to mark from here to here, but how do we really know that the one we have marked is really the swing high? So if price is coming downside, and if it has consolidated and came down maybe to around this level, then it's definitely a pullback. Like if it just gets stopped at some level, then just consider that as a swing point. All right. So the basic principle of drawing Fibonacci is from the swing low to the swing high. All right. So we had two things to discuss. Like one was Fibonacci golden ratio, and the second one was premium discount areas. So the good thing about the golden ratio is that it's the level between 61.8 and 78.6. Like this area right here is actually the Fibonacci golden ratio. All right. So there are some levels above this as well, but what I don't like about that is that that is actually in a premium range. All right. So it's in a premium range, and it's not ideal to buy from premium range. Rather, it's ideal to buy from discount range, and it's ideal to sell from premium range. So this golden ratio usually not it's a must that it should be in a discount range when we are looking for long setup, and seeing talking about the short setup, it's must that it should be in the premium range. All right. So we had this. All right. So in here you can see that this Fibonacci golden ratio is in the premium range, and the price goes up, and we have the premium range, we have the golden ratio, and we can look for short setup. And in here we have a market structure to the upside, a pullback, and we are looking for long setups, and we have this discount. So yeah, the Fibonacci golden ratio aligns with the premium and discount range. Whatever you are trading, like if you're trading long setup, it will always be in your discount range, and obviously if you're looking for short setup, it would always be in your premium range. All right. So just note that you just need these four levels: 105 levels, 786, 618, and 0.5. All right. So the area between this 6.618 and 786 is the Fibonacci golden ratio. All right. So just hold on a minute, bro. Guys, I'll be back.
Okay. We're gonna start for a little bit, but probably in a few minutes' time, he will be taking over again. But in the meantime, um, I just want to give a little summary of what Renee is trying to, teach you all. And then, like I said earlier, for those of you who don't find his art sets, who find his assets a little bit complicated to understand or mine, you could use the caption button below, which would help you, break down the whole stuff easily. Okay, so when it's basically going through smart money concepts and the retail concept also, and the golden rules of using Fibonacci, and also he's going through liquidity and trying to spot entries and patterns which he used in his personal trading. Okay, so a lot of you find structure a little bit complicated when it comes to understanding structure, right? And then you don't know which high to pick, which high to trust. I'm just going to list out some things for you, which would help you when it comes to understanding structure, and then trying to understand which high uh, and which low it's probably going to hold. Okay, so currently, there are some credentials when it comes to picking a POI, or when it comes to understanding where you should pick as an area of interest. As you all know, I do trade multiple approach of the markets, but most of all, and which I love the most, is the smart money concept. Okay, so which was the original concept which I learned before I started studying um, ICT, Wyckoff, Elotwave, harmonic pattern and all. And a lot of you don't understand or find it difficult to understand all those stuffs, but find it amazing how I'm easily, adapting to all these methods. So I'm going to give you guys a brief understanding of what I do, basically at the beginning, which helps me to understand this concept, which was basically what when I was, explaining earlier. Okay, so I'm going to share my screen and then explain that on the billboard. Okay, give me a few minutes. All right. So someone please signify on the chat box that you could see my screen.
Yes, Jay, it's visible.
All right, all right. Okay, so um, I'm just going to be using GBPJPY because it's one of my favorite pairs and has a lot of clean price action when it comes to understanding price action. Okay, so and a lot of people don't understand this, but there's some pairs which are quite easy to trade when it comes to price action because you have to understand that all these are being driven by money. Okay, it's being driven by liquidity, and then the liquidity are being built by investors and all. So these investors are going to be investing in pairs they know are very popular and traded by retail traders. Okay, so they'll be able to manipulate the whole stuff and do the whole thing over and over again. So if you're going to be picking a pair, it's quite advisable to trade a very popular pair. I know a lot of you say or see me do a lot of analysis when it comes to pairs, and then you don't understand which pair I'm analyzing or why or how I find it so easy to understand multiple pairs at the same time. All I do is I follow structure. Okay, so I'm going to give you a basic concept of structure, which I follow most of the time, which helps me when it comes to understanding liquidity. Okay, so basically, we don't know the basic rules of structure, right? Which is the lower low, lower highs, lower low, lower highs, lower low, lower highs, and the lower low. Right? Everyone understands this because when it comes to trading in general, this is basically the first methodology which you're taught. Okay. All right. So basically, this is the key and the most important part of trading. You have to understand these structures. Okay. So now once this is understood, you use this in multiple time frame analysis. Let's say you're coming from the higher time frame to the lower time frame. The top down analysis stuff. You start from the monthly, then coming down to probably the 1 minute time frame because I do what I do on the monthly down to the 1 minute, which is how I get my entries. Okay, it's all the same method being repeated. All right, and then once you understand these methods, you find it easier to apply it to whichever method of trading you want to, because price in general moves in structure. Okay, if you don't understand what I mean that price in general. Let me say something like this: lower low, lower highs, lower low, lower highs, lower low, lower highs, lower low. Okay, so in this structure, you could easily find a Fibonacci trader looking at this and saying price is retracing into the fifth, the 80. This is the 88.9 Fibonacci level, and then he also sees a strong resistance building up right here. You get what I'm trying to say? And then he says if the resistance holds, he's going to be placing a trade from here, which is stop loss above this high, and then the lows will be his target because he's expecting price to go on the downtrend. Okay, because price is reacting for a major resistance level. You see what I'm trying to do here? You see what I'm doing, right? This is a major resistance level because I'm 100% sure, you know, you see, it has a record of being a strong resistance and holding the price back. So this could be a POI for him. And then at the same time, this could also be a significant Fibonacci level, which you would also be looking at, which would be this, close to the 50% Fibonacci level, which has a resistance below it. Okay, so now price taps into the resistance and then breaks a double resistance. Okay, and now it's testing the 68 Fibonacci level of this range. You see, you see how this all makes sense, and then it feels as if I'm actually using this method of trading, which I don't know how to use. And I won't lie, I just developed this. I just thought about this and decided to use it as a method to explain this to you. Okay, so you get what I'm trying to say. This is someone using resistance, support and resistance, and also using Fibonacci at the same time. Okay, that doesn't mean he's wrong. The only thing he's doing here, which is familiar with what an SMC trader is doing, is that he's following structure, which is the basic concept of trading, which I believe everyone is supposed to know. Okay, because with this method, and once you understand the structures on the downtrend, okay, you would find it easier for you to, understand the trade better. Okay, the only reason why a lot of people prefer smart money concepts is because it has a, you know, better risk to reward ratio than a support and resistance would, right? So there's nothing really special about an SMC trader, and then different from support and resistance trader. It's all the same thing, okay? So all you have to do is understand the methodology and then also understand structure of what you're doing, right? So now I'm just explaining this as an example. Just going to be removing that now. But then let's say a Wyckoff trader was looking at this. At the same time, he might be saying this as a buying climax, right? AR, ST, you all know the concepts of Wyckoff, right? The joins, okay? So then he's seeing this as a UT, an uptrust, and then seeing this as a UTAD, okay? And then he sees this as a change of character, and then see this as a test. You see? Then this becomes his POI, and then this setup becomes invalidated once price goes up above the UTAD, right? And then he might target the lows because he's expecting the distribution to last long, probably to take out this low because this was an accumulation which happened right here. Okay, so you see what I'm trying to say here? It's all the same method, which was still seen by um, a Fibonacci and retracement trader, which he used earlier, and exactly the same POI. And what was the similarity between these two? The resistance trader never looked at this as a buying climax, right? But then it was the same thing. All he had to do was just follow the structures. All right. So you should understand that basically, once you're trying to trade, structure is everything. You have to understand what the structure is doing. Okay. So I want to ask if you guys are following up, and with this, which I just explained, you quite understand what I'm saying, and then you see this as um, a valuable knowledge. I want someone to explain to me what you have understood for just what I just said right now. Okay, what is the similarity? It's like a question. I'm asking a question now. Let's say you're being asked from the webinar when it comes to understanding structure, because this was a structure section. I just explained what I do basically when it comes to structure, right? So now I'm asking a question. What or do you want me to do a little more similarities and comparison? Because I just did a comparison when it comes to SMC. Sorry, I didn't do SSC, Wyckoff, and then a resistance trader. But then let me do an SMC trader. Let's say the same scenario, the same setup, the same POI. An SMC trader will be looking at this as a break of structure here, right? If I'm wrong, please correct me. Okay, those who are SMC traders in the webinar, if I do something wrong, do where to correct me, okay? And then they would say this cleared out liquidity, right? They would say this was liquidity, which was a resistance to traders, right? So it cleared out liquidity and then book structure. Or you could say a change of character, right? Because this would be the main low, and this you would consider a break of structure, right? But this you would call a change of character because the demand clearly did not hold against the support, while the support did clear liquidity into a higher time frame support zone, which is right here, right? So this becomes a POI because this would be liquidity. Let me just delete this, and this would be liquidity, and this would be a supply zone, which will be the point of interest where you would expect price to react from, right? So this is what an SMC trader clearly would do, and then probably go to the lower time frame and get a proper entry, and then have their chart look like this, right? So you see, it's clearly the same thing, which um, a Wyckoff trader would do, and then also the same thing a resistance trader would do. But then, what was the similarity which the SMC trader, the Wyckoff trader, and then the support and resistance trader has within this? This is something that a lot of people don't pay attention to, which actually helps in understanding confluence trading. Okay, then let me do another method and then show you how all these is one part of the chart. Okay, so this is what an SMC trader would do, and then show you how all this is one part of the chart, and at the same time POI. Let
Uh,
me go to the higher time frame and I will show you. Chart is loading. Okay,
Jay, can
you
you
see?
just repeat your stuff because your voice was not clear in the last 15 seconds.
Okay. I said let me do ICT method and then show you how ICT traders will be looking at the same POI, which I just did a breakdown of Wyckoff, SMC, and support and resistance. Okay, so that's clear enough, right?
Yes, perfect, perfect.
Okay, so this an ICT trader will be looking at this as a fair value gap being filled, right? And then we'd also be looking at this as the breaker block, which was mitigated by this other block. So this would be a genius block, which I can't really remember where I found it from. But then which I can't really remember where I found it from. But then found that is a thing also. So there you have it. So you see, this becomes the breaker POI, which was gotten refined from fair value gap, right? So price within the fair value gap, you see how this all makes sense, and then it's all different methodology within one POI. Okay, so clearly I could do all this and then send it out to you guys, and at the same time, a wave trader will be seeing me making sense, and an ICT trader will be seeing me making sense. Same time, everybody will be seeing me making sense, and it will be marveling to them how I was able to understand all these methods, and unknowingly that this was all understood within a matter of seconds because I just did all this over and over again, and I never read any book, any PDF file, or anything about this particular method. But then anyone who sees this would say, yeah, it makes a lot of sense. Monthly low, or let me say this, okay? And then they would say this is the breakup block within the 50% of or the full percentage of the fair value gap. Okay, and then you see prices dropping back down because this would be the POI, and then probably the entry would be right here. So you see, it's all the same method, but then same POI, same area of interest, and it's all different, approach of the market. So what is similar in this market which makes this all to work? Why is this working? Okay, so why is the market reversing at that particular spot? That's what you should focus on when you're trying to understand different methods of trading. Okay, so let's say you're trying to understand Wyckoff, at the same time understand SMC, and at the same time understand ICT and all. But then whenever you look at this, let's say you're an SMC trader, but whenever you look at this, all you can see is your SMC structure. Okay, how do you find um, the sorry, I had a notification. Okay, so how do you find a Wyckoff within this when all you could clearly see is a break of structure and the liquidity swap, which is you being an SMC trader? Or how would you find a Wyckoff when all you could see is resistance because you're a resistance trader? Okay, or how would you find a Wyckoff when you're an ICT trader and all you could see is an imbalance being filled up at the same time mitigating a breaker block? All right, how do you find all that? That is easy because clearly once you understand structure, that becomes very simple and easy for you to understand. Now let's say this was twice and then I've never done this. Okay, let me try the back testing too. Let's say price was no. Let me go back a little bit so it makes it more easier for you all to understand. Okay, so now let's do this. Let's say I was to be trading this chart right now, and then let me not pick any particular strategy. Let me say I'm trying to trade this and then just follow structure. Okay, all I can see is a higher high, lower high, higher high, lower high, right? Higher high, lower high. Please correct me if I'm making a mistake, because sometimes this is a little bit tricky, and then you miss call a higher lower, low, higher higher stuff like that. But then something like this. Okay, so this was the range which structure was moving in, and then structure did this, created a higher low, was supposed to create a higher high, but then created a lower low, right? But then in the process of this price book structure right here, and then we have a break of structure. So if I was trading just structure, this would be the break of structure, right? Let me write that in full. Okay, so this was a break of structure, and then now I know price is bearish, and I should be looking for bearish scenarios. So if price should be returning, this was the current range of the market within this range. Okay, this I'm about to draw is within this range of the market. We had a lower low, lower high, lower low. So we're expecting price to return into a higher high, right? So you could see what the current range we have is this. So if price is going to be returning back, price has to return probably into the premium of this range since we're in um, a downtrend, right? But then price never returned into premium of this before going back down. Okay, so this could have a clear explanation on the lower time frame. But then I'm just using structure. So if you were just using structure, probably you might have not have gotten an entry on this particular POI. So then price moves lower. Let me clear this so it becomes easier for you to understand. So then price moves lower, creating a lower low. So now you're expecting a higher low within this range. Okay, so I'm just using structure right here. So pay attention, okay? So now this becomes your new range. You're expecting price to trade in, because if price should take out this high, it means it's creating a higher high, right? So now we're still in a bearish market. So now you're expecting price to return into premium of this range, right? Since there's a break of structure. And what does price do? Price comes close to the range again and then did not return before going back down. I'm not using any POI, so this wasn't. I know most of you would have been saying price acted from the hidden order block within this week, but then I'm not using any POI. I'm just using premium and discount, and also using lower lows and lower highs, or higher highs and lower lows, whichever you want to call it. Okay. So now you could see after that, price goes up, creates a higher low, returns back down. I'm not using any Fibonacci or picking any particular POIs. Okay, so then on this range, what does price do? Price returns into premium because it's a smaller range, and then fills it all up. So probably might have got an entry from this because we'll be looking at premium. So within this, only this would have been our POI, our area of interest because it's premium of the. And don't forget, this is just the weekly, all right? So this is just understanding structure, not an entry. Okay, probably at the end of the 3 days webinar, you should understand all this, putting them all together. Okay, so we're going steps by step and trying to understand this day after day. Okay, so today I'm just going to be clearing a little bit about structure from what when I told you guys earlier. Okay, so now you could see price creates a higher low, or is it? Yeah, that's a higher low, right? Then creates a lower low, right? Then we see a new higher low being created. Oh, sorry, we had a range right here, right? This was a range, lower low, lower high. So this within this range, we look at premium and discounts, and what do we find? Price returns into premium, then continues to the downside. So this becomes the new range from this high to this low. All right, so at the end of this, you're also going to know how to spot a reversal and how to know when price is about to drop, how to know when price is going to be returning back down, how to know when to expect a higher low to be created and all. But for now, we're just going to be explaining structure and how this different method of trading works perfectly fine in the same POI. Okay, so now we see price returns back up, creates a higher low without entering into premium. Then what the price do? Price returns back down and then creates a lower low. So this becomes the new range. All right. Now we're not expecting price to reverse anytime soon. We're just going to be following the structure. And what do we find? Price creates a higher high instead of a higher low, right? And then in the same process, what do we expect? We expect price to return back down into or into discount of this range because this was a bullish scenario, right? And what happens? Price mitigates this discount zone and then returns back up, right? So what happens? Let's see. Now on this side of the range, we see that price never created a higher high, right? So this was a higher low, but then did not create a lower low either. So this becomes a range, a consolidation because this becomes a range. So if you're using structure, all you do is observe what's happening in here. Now this is where the accumulation, manipulation, and all comes in. But then we're only understanding what structure is doing. Okay, so let's assume we know nothing about that. Neither do we know anything about um, the ICT accumulation, manipulation, and distribution. We don't know Y curve. We don't know anything. All we know is higher highs and higher lows and lower highs. This would be how you use them. Okay. All we know is to take your area of interest within premium when price is on a downtrend, and take your areas of interest within discount when price is on uptrend. You could note that down if you're understanding me. You could take that down and then probably at the end of this section backtest it on your own and see what you can find. Okay, so I will repeat that again so you could jot that down. When you're doing your analysis, all you have to understand at the beginning is what is price doing. Is this price creating a higher high or a higher low, or is price creating a lower low or a lower high? Once you understand that, then you know the direction of price. Then you know if price is in a range or if price is consolidating. Currently on this range, we see that price is not creating a higher high, which is right here. Neither is price creating a lower low. Price is within. You see, price is creating a lower low. So if price was right here right now, you would know that price is on the downtrend. All you have to do is put your area of interest at the premium of this current range. Okay, if price creates a lower low, you understand that price on it is still on the downtrend until price breaks this high. Price is not on an uptrend. Okay, so now price creates a lower low and then returns back up. All you have to do is pay attention to premium to look for sales, and then within discount to look for buys. Okay, now you see on this range the opposite happens. Price breaks creates a higher high, and then returns into discount. Okay, so you see, all you do is premium and discount, and this is the basic concept of trading. A lot of people make this mistake when they come into trading, and what they try to do is, um, so now I see price is reacting from the breaker. That's wrong. That's very very wrong. What you do at first is you understand what is price doing, where is price heading. Price could be reacting from the breaker block, yes, but is price ready to go back down? Why would price be going back down? What's the essence of price going back down? You have to understand what price is doing before you get the direction of price. That's how structure works. All right. So now we see here price is undecided because it's in consolidation box, which is a range. Okay. So now price goes up to create a higher high, from this range. So now we know a new range is formed, and from this low to this high is a new range. Okay, because price finally creates a higher high. Okay. So now what happens? We see price comes back down. Still, the same thing happening on a lower time frame. Price is consolidating. Price doesn't create a higher high. Neither does it create a lower high. It's just within the box. So this is all you have to understand about structure. Okay. So I just did this to let you understand structure. Why before I go into understanding the POIs. Okay. So once that is understood, the basic concept of trading. I know a lot of you already understand what higher highs and higher lows mean, but we have a lot of time. So it's better to give the knowledge like a beginner, down to a pro. So at the beginning, it looks a little easier and then understandable to you all. And if it gets complicated, by then you should understand all of this because this was explained to you earlier. Okay, so now you understand structure. So if you were to look at this range, what would you understand? You would say the price had this range right here, right? But before this range, we had this range, which was this lower low, lower high, lower low, higher high, right? Remember what I told you guys? I told you guys if price is on an uptrend, all you have to do is look for price within discount, right? And now where is price? Price is within discount. Okay, now we're still using the range here. None of us is using another block, a POI, or anything like that. All we do is price and discount, right? So now price is within discount, and let me do that again if you still don't understand why we're paying attention to this, because on the higher range, price book structure here, right? And then we're expecting price to return into discount of this range before going back up, right? And then what we see, what do we see? We see price returns into discount, and then in the process of creating um, lower low, lower highs, lower low, lower highs, lower low, lower highs, lower lows, higher high, right? So this is a change of character. This is another break of structure, which could also um, give us an opportunity to look for entries because price finally broke structure and is within discounts of the higher time frame range, right? This was also a break of structure. So now on this, with this knowledge you have, price is now creating a higher low, right? This would have been your first entries because if you were paying attention to premium and discount of this range, you would know that you should pay attention to this once price comes into this zone, right? So you would have gotten this entry for price to head back up to take out this high. So which means price is bullish, right? But then this happens, price goes back up, and now you see this is a new range, right?